Okay. So today we'll be looking at the valuation of securities. Valuation of securities, and that is our second topic. That is our second topic. Okay. So what is valuation of securities? Here it's about we knowing the values of some securities, right? Or securities. And what are the securities here? Here we have the bonds and shares, right? I believe we can give a number of securities. So here we have um, shares and what bonds, shares and bonds, shares and what bonds. So securities, what are securities? So basically, I would say that securities are pieces of papers or instruments, pieces or instruments that are issued that are what issued. So pieces of papers or instruments that are issued for what? That are issued for what? I'm talking to you guys. Issued for
Capital.
that are issued for capital. That are issued to raise funds, to raise capital. What else? And now that is all. Okay, Ayo. So that are issued to raise funds or capital. Ayo. Okay. So they are also known as financial vehicles, right? Securities are also known as what? Financial vehicles. So what are some of the examples of the securities that we can mention of? I've mentioned two already. Examples are I've I've already said bonds. What else? Shares. What else?
Treasury bill.
Okay, treasury bill. What else? Okay, and many more, right? And many more. So these are some examples of what of the securities, right? of the securities of the securities. Okay, so now let us look at the valuation of which one should we start with? Valuation of bonds or valuation of securities? Um,
Bonds.
okay, so let's start with the valuation of bonds. Valuation of bonds. Valuation of bonds. Okay, so valuation of bonds. So what are bonds? Or what is a bond? A bond is a long-term what? It's a long-term security. It's a long-term security. It's a long-term security or debt. It's a long-term security or debt. Or let's say debt security, long-term debt security issued by who? Issued by government, issued by government and companies, issued by government and what companies and companies to raise funds. It's a long-term or debt to raise funds, right? So from this definition, can sole proprietorship entity issue bonds? Can sole proprietorship firm issue bonds?
No, sir.
What of partnership? Partnership businesses, can they issue bonds? Can partnership entity issue bonds?
No, please.
Hey, I was speaking to the class. Can the partnership business issue bonds? Where are the rest? Okay, so let us look at some of the examples of the bonds. Examples of the bonds. We have the euro bonds. Euro bonds. What else? You see that the president, former president, would have been saying we've issued an euro bond. So that is a loan, right? A long-term loan. So that is an example of the bonds. We have the municipal bonds. Municipal bonds. What else? We have corporate bonds. Corporate bonds. What else? Coupon bonds. What else? And many more, right? And many more. And many more. And many more. All right. So now let us look at the actual valuation of the bond, right? Valuation of the bond, right? Actual valuation of the bond. So we have irredeemable bonds or debt, irredeemable debt, and then redeemable debt. We have irredeemable debt and then what? Redeemable what? Debt. Redeemable debt. So irredeemable debt. What do you think is irredeemable debt? When you say a debt is an irredeemable debt, what does it mean? Irredeem. Irredeemable debt. What does it mean? Yes, I'm sure you read academic writing 1 and 2, right? Or it's been long, so you've forgotten. Hello.
So, sir,
What is an irredeemable debt? Where are the rest?
there
Ophelia, are you here? Ophelia, are you here? Hey, she's not here. Okay. So what is an irredeemable debt? Okay, so as the name goes, irredeemable debt is a debt that is never paid, right? It is a debt that is never paid. So it is a debt that is never paid. It is a debt that is never paid. Let me say that is never repaid. Repaid, need paid. Isn't not the same thing. Repaid, that is never repaid. Right? So if the debt then what does it mean? So it is a debt that is never repaid. But then the holder, so the holder of this debt, the holder of the debt will be paying the what? The interest on the debt. So irredeemable. You cannot redeem the debt, but you just be paying the interest, right? We simply so the holder of this debt will simply receive the interest on the debt, right? The holder, so the issuer will be paying the holder the interest on the debt. The holder of the debt simply receive will simply receive receive interest each year, each year forever. So if you receiving interest each year forever on the debt, you not pay the lump sum, right? You just be paying the interest on the debt forever, right? So you'll be paying it forever, or unless maybe they decide that they are going to sell it at the stock exchange. So they choose, unless they choose to sell it to the stock exchange, to the stock what exchange, right? So that is an irredeemable debt, and these debts are normally issued in units. I'm sure I said that when we're doing the sources of finance. So they are issued. They are issued in what? In they are issued in what unit? They are issued in units, right? So here, see 1 unit, example, maybe 1 unit is equal to 100 cedis. So 100 cedis face value, right? Usually in face value. But sometimes you will see 1,000. Some people try to use 1,000. So 100 units or maybe 1,000. Yeah, but usually 100 units. It's usually in what? 100 units. 100, right? 100 units. Okay. So now, um, that is the what? Irredeemable debt. Irredeemable debt. That is the irredeemable debt. So under the irredeemable debt, we have the irredeemable debt looks at the debt from the point of view of the investor, right? The investor. It looks at the debt from the point of view from the investor. And here, what is the name given to the investor? What is the name for the investor? Hello, what is the name for the investor? Hey, you don't know the name of the investor of the debt. The investor is someone who is giving out the money. The one giving out the money. What is the name given to the person? Of the investor. So the name of the investor is the holder, right? The holder of the debt, the holder of the bond, the holder of the bond, right? So that I said the holder of the debt will simply receive interest each year forever. He is the holder of the bond. He is the investor. He invested his money. He gave out his money to the issuer. The issuer is the one receiving the money. So that's why we say that we've issued an euro bond, right? When maybe the government will say that we've issued an euro bond. Issue an euro bond here means that we've gone for loan, right? By using the terminologies, right? So that would tell whether you have done finance before or not. Because he said you've issued an euro bond. We will not say that we've gone for loan. We've not, as a country, we've gone for loan, right? I would say we've issued an euro bond. Issue means we are going for the loan. We've given out papers. We've given out papers to them, and we are taking their monies, right? So the debt holder is the one receiving the interest each year forever, right? So here under the irredeemable debt, we look at it from the point of view of the investor, from the perspective of the investor, right? So that is usually before tax are charged. So before we charge what tax, before taxes were charged, before taxes were charged. Okay. So now, okay. So that is point of view of what of the investor, right? And then we have cost of capital. what do you think the cost of capital will be for? The cost of capital is basically looking at the interest, right? The interest that you'll be paying on the debt. So that one will be at the point of view of what? Of the company. So cost of capital will be what? Will be from the point of view of the company, because the company is issuing the debt. So the company would be paying the cost on it. What I say, the cost on the capital. The cost of what? Capital. The cost of the capital. So how do we get the formula for the irredeemable debt? For the irredeemable debt, so if you want to know the market value for irredeemable would be the interest over the cost of the debt, right? The interest over the cost of what? The debt. Interest over cost of the debt with respect to the market value, right? So with this, if you have to get the cost of debt, I believe you can make the cost of debt the subject from here, right? So here, the market value is the interest. Interest here, we are talking about the coupon. Coupon. Interest is the same as coupon. And the coupon is on the face value. On face value or the nominal value. On face value or the nominal value. I have not given the definition for the terminologies. So I'm thinking you might be asking what is face value, what is nominal value or nominal value, and then the coupon. All over what? The cost of debt. So here the pre-tax cost of debt, the pre-tax cost of what? Debt. And here it's with respect to the investor, right? So the investor's rate of return, investors required rate of return. All right, so before we try to look at an example for the irredeemable debt, to be precise, I would like to give the meaning of the terminologies, right? The meaning of the terminologies before I proceed. I should have brought that one, the terminologies first before I continue with the irredeemable debt, right? So how do we get the price of the bond? How do we get the price of the bond? The price of a bond, so the price of a bond, if you want to know the price of a bond in general is the present value of all the cash flows from the bonds. So you are discounting the cash flows of the bond, right? The present value of all the cash flows of the bond. So that is the regular coupons and the face value. And the present value of the cash flow has so that is the regular coupons. So your coupon here means the interest. When you say coupon under bonds, it means the interest that you'll be paying on the debt or the interest that you'll be paying on the loan, right? So regular coupons which is the interest, and the face value, and the what? Face value, and the face value, and the face value, right? So what is coupon? What is face value? So coupon here means these are the interest. These are the interest on the bond. Interest on the bond. What is the face value? The face value here, because we said the price of the bond is the cash flow of the bonds, right? Which is the regular coupons plus the face value. So what is the coupon? Coupon here is the interest on the bond that you'll be paying. And the face value here is the amount that will be paid at the end of the bond maturity, right? Amount that will be paid at the end of the bond maturity, or the principal in short terms, right? So that is the principal. So amount paid at the end of the bond, maturity, at the end of the bond maturity, or the principal. At the end of the bond maturity, or the principal. So usually they are paid, I mean, with the coupons are usually paid maybe 6 months or semi-annually. Yeah, semi-annually. So maybe 6 months, or maybe annually. You pay it at the end of the year, right? At the end of the year. So okay, so let's continue with the definition before we take an example. It's too early. So now let's look at the bond agreement. Who is a business finance student here? Is there any business finance student? Any business finance student? Or you are all accounting student? All right. So let's look at the bond agreement. So you see, before you enter into you get a bond, there must be an agreement, right? There must be an agreement between the holder and then the issuer, right? So the bond agreement are documented in a document called in a document called the bond indenture. The bond agreement are documented in the bond was indenture. So that's where the bond agreement is documented in. So what are some of the things that are found in the bond indenture? So the bond indenture includes so we have the bond maturity, period, the regular coupons. So what are the regular coupons that will be paying? Regular interest, right? Regular coupons, regular interest. The face value, the coupon rate, the coupon what rate, the coupon rate, the face value, the regular what coupons, right? So these are found in the bond indenture. These are found in the bond what indenture. These are found in the bond indenture. So now let's look at the price. What is the price of a bond? When we say price of a bond, price of a bond. So know that this one is the market value with respect to irredeemable debt specifically. So we'll come to redeemable debt as well, but we are holding on for now. Now we are holding on for this. So we have done irredeemable debt. We'll come back to redeemable debt and also look at its formula. But now we want to generally look at the price of a bond. When you say what is the price of this bond, so now we look at the terminologies, the coupons and the face value, and then we looked at the bond indenture, what is included in the bond indenture. So when we say price of a bond, what is the price of a bond? The price of a bond is the present value of the coupons, present value of the coupons plus the present value of the face value, right? Present value of the face value. Present value of the face value. So what is the formula for the coupon? So that is the same formula that we know, right? In the formula that we did, those of you who read business mathematics, you will be familiar with how to find annuity, the annuity formula. So here, that is 1 minus into bracket 1 plus r exponent n all over r, right? All over r. So that is the formula for the present value of the interest. For present value of the interest. That is like the annuity formula. And the present value of the future face value. The face value is a single amount. So it's face value Fn all over 1 plus r. If you are here with you and you did business maths with me, I told you that the formulas you are seeing there, you would apply it throughout your education career, right? Throughout your education. Because the things are similar. The things are some of the things that you did, you'll be applying them. So this is the formula. This also can be written as C over R into bracket 1 plus R n minus 1 all over 1 plus R exponent n. And that will also give you the same answer. So whichever you are conversant with, you use it like that. Plus the face value, because it is a single amount. So that is the face value of over 1 plus R exponent n. So that is basically the price of a bond. That is price of a bond. When you say price of a bond, generally this is the price of a bond. So let's look at a short example and see how we are going to apply this. Some people might have been seeing it for the first time, maybe the BA student who didn't read business mathematics. So example, a company issued a 10%. A company issued a 10% coupon bond. With a face value of 1,000 cedis. That pays coupons semi-annually. semi-annually for 3 years. Semi-annually for 3 years. If the required rate of return is 12%, the required rate of is 12%, calculate the price of the bond. So what is the price of the bond? So the price of the bond is the present value of the coupon of the coupons plus the present value of the face value, right? Present value of the face value. What is the present value of the coupons? That is C into bracket 1 minus 1 plus R exponent minus N all over R plus the face value all over 1 plus R exponent what N. Exponent what N. All right, so what is our C? Our C is the annual coupon. C is the annual coupon. What is our F? FV. FV is the face value. And the face value was given at what? 1,000, right? 1,000. Then we have the number of the N. The N is the, so let's even find our C. We say C is the annual coupon. So what is the annual coupon? The C is it 10%? Yeah, 10%. So 10% times the face value. Times the face value of 100 will give us 1,000 will give us what? 100. So that is the C, the annual coupon, right? And then our N is 3 years.
100. Maybe
3 years, right? It's 3 years. And what is our R? The R is 12%, right? 12%. All right. So here we are doing with semi-annually, right? So semi-annually, do you remember when it's semi-annually, you have to divide the rate because the rate that is given is annual. So semi-annual divide by 2. Divide by 2 and you multiply this one also by what? 2. So what do you have? 6 years. And this one will be what? 6%. 6%, right? 6 years and then 6%. So then what is the price of the bond? Price of the bond is what is the price of the price of the bond is did we divide the coupon? The coupons we have to divide it by 2, right?
Yes.
Divide the coupon as well by 2. So what are we getting? 50, right? So 50 1 minus 1 plus R. What is the R? 6%? 0.06. exponent minus n minus 6 all over what?
All over zero.
All over r, which is 0.06. Plus the face value. Face value is what is that? 1,000 all over the rate 1 plus the rate 0.06 exponent 6 years. So you punch it on your calculator. You first of all have to do this one. Then when you get the answer, you plus 1,000 over 1 plus 0.06 exponent 6. So what is the present value of this bond?
Hello.
Yeah, what did you get?
Please, I don't understand why the number of years is also times 2.
Number of years is times 2. That is because of the semi-annual. Did you read business maths? You did financial mathematics. It was the same thing. When you divide the interest rate, because the interest rate given is per annum, so you divide it by 2 and you multiply the number of years also by 2. Because if it's semi-annual, assuming it was monthly, we would have divided this one by 12, and then you multiply the number of years by 12. Because you'll be paying it.
It's only the rate too.
It's only the what?
Definitely, please. I was thinking it's only the rate that we are going to divide it by.
By 2, We are not, the number of years, you're not dividing, we are multiplying. So what's the answer?
950.
Are you all getting 950?
Please,
Hey,
should we
so
add
where are
the
the rest?
point?
Yeah, you can add the point. Maybe 2 decimal place, since it's the final answer.
Okay, so it's 950.83.
Did you all get that? Hey, class, is there only 2 people in the class? The rest, why are you not willing to talk? I want me to remove you. You are in class, they ask you question, you not speak. Hey, live, man. One person will be doing the calculation. All right, so now let's move on with the types of bonds. Types of bonds.
Please, I have a question.
So we have the coupon paying bonds and the non-coupon paying bonds, right? The bond that pay coupons and the ones that does not pay coupons, right? And the ones that do not pay coupons, they are known as the zero coupon bonds. Zero coupon what? Bonds, right? So a zero coupon bond, with that one, as the name goes, zero coupon, it does not pay interest, it does not pay coupon. So if you are to calculate the, so we have the coupon paying bonds, coupon paying bonds, and the non-coupon paying bonds, or the zero non-coupon paying what? Paying bonds, or the zero coupon paying bonds, or the zero coupon bonds.
Mr. President.
So
Hello.
yes, yeah.
Please, the irredeemable debt is not a type of bond. Like the irredeemable and redeemable debt.
It's also it's like a form of debt. It's like a form of debt. The debt can be redeemable. It can be a redeemable debt.
Okay, but it's not related to bond.
I said debt is the same as bond.
Oh, okay, so it's a form of bond.
Okay, so but some people can also add it like also a type of bond. So irredeemable debt, redeemable debt. Yeah, some people can add it like that.
Okay.
Some people can add it like that. Okay. So a zero coupon paying bond, because it does not pay interest, what do you think will be the price? The price of that bond will be the price of that bond. So the price of a zero coupon bond is the face value over the 1 plus r exponent n. That one, it doesn't pay coupon, it doesn't pay interest. So the price of that bond is just the face value over 1 plus n, right? Just the price, the face value over 1 plus what n. So that one, when you are given like they just do this and then you get the answer, right? So that is it. Okay. So let's look at, so before we come to valuation of the redeemable debt, and also maybe we'll solve 1-2 question on irredeemable debt. we are still on let's look at the relationship between bond price and yield to maturity. Relationship between bond price and yield towards maturity. The yield to maturity is known as the interest rate. So relationship between bond price and yield to maturity. So the yield to maturity is opportunity cost. Yield to maturity is same as the interest rate or the what opportunity cost or the opportunity cost. Okay. So what is the relationship between the bond price and the yield to maturity? The bond price and the yield to maturity. There is a relationship between the two. So what is there? So there is an inverse relationship. There is an inverse relationship. There's an inverse relationship between the bond price and the yield to maturity. So what is the relationship? There's an inverse, means an opposite relationship, negative relationship, right? So what is the relationship? That is, the higher the yield to maturity, the lower the price. The higher the yield to maturity, the lower the what? Price of the bond, right? And vice versa. So the lower the yield to maturity, the higher the what? The price. So and vice versa. So this can be classified under the following. This can be classified under the following. We have one, a premium bond. A premium bond. A premium bond. Is there anyone here doing business finance? No, you are all FM students. Okay. So the premium bond is a bond whose price exceeds, here this bond, the price exceeds the face value. Price exceeds the face value, right? The price would always exceed a face value. So it means you are buying the bond at a premium. When you buy it at a premium, or when the bond is at a premium, it means the price of the bond exceeds the face value. So if the face value is 1,000, what do you think will be the premium? It will be say 1,200, right? You see that the amount computed would be higher than the face value, right? So that is the price of the bond, the premium bond, So here, so that is when usually when the coupon rate, when the coupon rate exceeds the yield to maturity. The coupon rate from the example that we saw, we're given 10% coupon rate, and we multiply it by the coupon, and we had 100. So this is the coupon rate. Coupon rate is not the same as the yield to maturity, interest rate. Coupon rate is not the same as what? The yield to maturity or the interest rate. So now, we're saying that when it's at a premium, the coupon rate is greater than the yield to maturity. Yield to what? Maturity. So I believe the first question that we saw, we were given the coupon rate as 10%, and we are given a rate, the interest rate, yield to maturity as 12%. So with the premium, we are saying that one, the coupon rate should be greater than the yield to maturity before we can say that it is at a premium. When you see that, you see the question now, say that the coupon rate is greater than the interest rate or the yield to maturity, then you know that it will be at a premium. But when it is lesser than that, then you know that it will be at a discount. So from here, we can see that the coupon rate is 10%, and then the interest rate is 12%. So it is lesser than the 12%, and then it is given as what? That is given as what? A discount bond. So let's look at a discount bond. The discount bond here, the price is less than the face value. Price is lesser than what? The face value. The price is less than the face value, right? So that is when the coupon rate is less than the yield to maturity. The yield to maturity. So you can see that from this question, definitely we'll get a price lower than the face value. The face value that we were given from the question was 1,000. So this is the face value 1,000. So we expect that the price computed, this price should be lower than this 1,000. Why? Because the coupon rate is lesser than the yield to maturity. The coupon rate is lesser than the yield to maturity, and that is informing us that this is a bond at a discount or discounted bond or discount bond, right? Why? Because it is gained at a discount. You are paying lesser than the face value. You are paying lesser than our face value. So the price is lesser than the face value. That is when the coupon rate is less than the yield to maturity. Yield to maturity. And then we have the par value, the par value bond, right? The par value bond. So with this, this is where the price is equal to the what? Is equal to the face value. The price is equal to the what? Face value. So here, that is where the coupon rate is equal to, here the coupon rate is equal to the yield to maturity. Is equal to the yield to maturity, right? So here, the par value, it means you are buying it at the par value. Par value is the same as what? Face value, right? The face value. Okay, so that one, you see that the coupon rate, if the coupon rate is 10%, the yield to maturity will also be 10%. then you know that the answer that you'll be getting when you compute the price of the bond is the same as the face value given. Because the face value is same as what the power value bond or the face value bond, right? So now let's move on to the bond rating. Bond rating. We have high grade bond and then medium, medium grade, medium grade bond. What else? Going to B minus, right? B minus, low grade, and then very low grade, right? So what is the high grade bond? So here, this is a bond which has a very extremely strong, or there is very strong capacity of payment. So there is a high probability that the person will pay. High grade bond. It means the person is likely to pay, right? When you give the person a bond, the person is highly likely to pay. So that is there is the capacity of strong payment. So usually it is graded as say maybe AAA or maybe 2A's, right? And then the medium one is graded as A or maybe is it BB? Yeah. And then we have the low grade um, bond, which is so the medium it has a strong capacity of payment, but not extremely like the high grade. The high grade is extremely they have extreme capacity, right? There's a high chance that the person it will be paid, right? And then we have the so here there's a strong capacity, but not extremely. And then low grade bond, it is there's a possibility, right? So possible capacity of payment. There's a possible capacity of payment. So there's a possible capacity of payment, or it could be defaulted. It could be that the person can default. The person can default, right? So B or maybe BA. Then a very low grade bond C, right? Uh-huh. Okay, so now all these that we are looking about usually relate more to the finance student, business finance student, the business finance student. But you as a financial management student, I also know this because in financial management they might not be talking about this, but business finance, this is usually in it. So now, having done that, now we can continue with our redeemable debt. But so we've talked about redeemable debt. So I think let's see if we can get an example on the redeemable debt, and then we solve maybe one question on that. Then we solve one question also on the redeemable debt. Then we shall call it a day. Okay. Okay. So I'm sharing it to the group. Mhm. Yeah, so someone should quickly read the first one. Have you seen the question? Under debt.
Example 1. PPLC has in issue $500,000, 10% irredeemable debentures. Investors currently require a rate of 8% per annum. What will be the market value of the debt?
Okay. Who just read?
Beatrice.
Who read? Who read? Who just read?
Mr. Philip, please, is Beatrice.
Oh, okay. Okay. So, example, and irredeemable debt. Let me go to the next question. Okay, so example 1. Is that a PPLC? Has issued 500,000 10% redeemable debentures, right? Investors currently require a return of what 8%. What will be the market value of the debt? Yeah. So what's the formula for the market value for the irredeemable debt? What's the formula? What's the formula for the market value? What's the formula for the market value of irredeemable debt?
Interest
Present
or
value of
coupon.
coupon plus present value of face value. Is it present value?
So the interest or the coupon, and the what? The investors required rate of return, right? The investors required rate of return. And so the investors required rate of return is what? The cost of debt, right? The cost of debt, pre-tax cost of debt. The pre-tax what? Cost of debt before tax, right? Not after tax. Pre-tax means before tax, not after tax. After you've deducted tax, cost of debt. All right. So what is the interest? What is the interest? How do you get the interest? Is that issue 500,000, 10% irredeemable what? Debentures. Investors currently require a return rate of what, 8%. Okay. So the interest or the coupon will be 10%. 10% on what? It will be 10% on what? 10% on the face value. So what is the face value here? It is denominated in units. So it is what? 100. Right? All over the cost of debt. What is the cost of debt? The cost of debt was given as investors currently require rate of return. I said this is the investors required rate of return. So the investor required rate of return is given as 8% or 0.08. So what then is the market value of this debt?
One, two.
What I get? So $125, right? It's in dollars. $125 per bond or what, or unit, per bond or unit, right? So now how do we get the unit? How do we get the unit? The unit is given as $500, right? $500,000 over the denominated in 100. I just said, but here it is dollars. So denominated in $100. Bond is denominated in $100 or the 100 currency, right? So here is dollars. So $100. So how do we get the unit? The unit is 500,000 divided by 100. What are I getting? $500,000 divided by 100. What are I getting?
5,000.
So that is unit is given as 5,000. So what is the total value of the debt? What is the actual total value of the debt? The total value of the debt is the market value times what? Times the unit. And that is given as what? What did we get for the market value of the debt? $125. $125 times the 5,000 units. And that is given as how much?
$625,000.
$625,000. So this is the market value of the debt. Example 2. Example 2. Hey, where is Beatrice?
Star Praiser.
I'm here.
Okay. Example
Example
2.
Please, I
two.
don't understand.
Okay.
Example 2 is what?
Someone says she doesn't understand, so let's go over.
She doesn't understand what? But Beatrice, you do understand?
Yes,
Beatrice, you
a little.
understand? A little.
Mm,
Can you explain?
okay, so from the little I understand, every one is it dollar will be equal to 100 units.
100 units, yeah. Of bonds
So
are in units. We count them in units. So bonds, 100 units, units. Uh-huh.
okay, so before you even tackle the question, the rate that has been given to you in the question, that's the redeemable debenture rate. You have to multiply it by the equivalent, which is the 100 units. So when you multiply it by it, that's finding the market value. Then you divide it by the interest rate that has been given in the question. That will help you to find the market value. So as in the first one that we did, 10%, then times 100. So the 100, you can see that in the question there was no 100 something, but we found 100 because that is the equivalent of the bond. That's the unit that I was talking about. Then you divide it by the interest rate in the question. So that's why we divided by the 8%, and we had 125. So after getting the 125, then now we are coming to take the value of the one that was issued. That's the one in the question, the 500,000. Then we divide it by the unit equivalent, which is the 100. Then you get another value again. So after getting the value, then you multiply it by the unit to get the total market value, if I'm correct.
Okay, so that is good. So basically, this is the price of the irredeemable debt. I don't know if you want to get total revenue, it's a price times quantity, right? So this market value that we are talking here is actually the price. So price, market value, right? That is the price. The formula is interest or the coupon over the cost of debt, as we said. Now the interest or the coupon. Remember when we were dealing with the coupon, we said they give us the coupon rate. The first example that we solved, they give us the coupon rate and we multiply it by the face value. Here the face value is in units. Under bonds, the face value is in 100 units. 100 units. So if you want to get the interest on the face value is or the coupon is what the 10% on um the 10% on the what on the 100. It is denominated in 100, right? So 10% times 100 will give you as the 10. Will give us 10, right? Will give us 10. So 10 over the cost of debt. Cost of debt is the investors' required rate of return. Investors currently require a return of 8%. We said that the irredeemable debt is from the perspective of the investor, right? And the irredeemable. When I said that, right? So um, the cost of debt is the paid cost of debt. You don't deduct tax, so we've not even been giving tax at all. But we were giving tax, so we use the paid tax cost of debt, right? We use the paid tax cost of debt. So after getting that, you get the value, the market value of per bond, market value per bond or per unit. So that's why we had 125 per the bond or the unit. Then we come and get the unit. The unit is like total revenue is equal to price times what quantity. if you want to get quantity, let's say something like this, TR is equal to PQ. If you want to get PQ, if you want to get Q, what do you do to the Q? You divide both sides by P. You divide both sides by P. P will cancel P. So what is our Q? Q is equal to total revenue over the price. What I say, so if you want to get the unit, you divide the total amount, which is $500, over the per unit, which is the 100, and then you are going to get the unit. So if you get the unit, then you multiply it by the what market value per the bond, then you get a total market value. Are you fine now?
Yes, please. Thank you.
Okay. Example 2.
Q PLC has in issue $1 million, 6% irredeemable debentures. Investors currently require a return of 12% per annum. What will be the market value of the debt?
Okay. So PLC, is it PLC? QPLC.
Yeah, QPLC.
So QPLC has what? Issued. So QPLC is the company. It has issued a bond, 6% irredeemable debentures. Investors currently require a rate of 12% per annum. What will be the market value? So it's the same thing. Can we try it on our own? Should I give you some time to do it?
Yes.
Okay, so try it on your own. I'm giving you 2 minutes. Yes. So what are you getting? What is the total market value? Okay.
I have
So
5
here
million.
the market value or the price of the irredeemable debt is the interest rate, the interest or the coupon, and over the cost of debt. What is the interest? It's a 6% irredeemable debt, so 6% on the face value. What is the face value? Face value is either 100 or 1,000. So 100 is either 100 or 1,000. So here 100 all over the cost of debt. What is the cost of debt? It's here 12%. 12%. So what is the market value of the bond? The price of the irredeemable bond,
50.
$50. $50 per bond. $50 per $50 per bond, right? Then how do we get the unit? The unit is 1 million over the face value amount, which is what? Is it 100? Yeah, 100. All over. So that will be given that. That's what. You don't cancel this. This will cancel this. So we are getting 10. Is it 10,000? 10,000 units. 10,000 is denominated in units. Units. So 10,000 units. So what will be the total market value? Total market value is what? The $50 times the 10,000 units. And that is giving us what? $500,000. So that is the valuation of debt, irredeemable debt, to be precise, irredeemable debt to be precise. That means we cannot look at the valuation of equity today. So in our next meeting, it will be valuation of equity. So now let's go to the valuation of irredeemable. Valuation of irredeemable debt. Valuation of debt. How did we make the first one? Was irredeemable debt. So now let's go to redeemable debt. The redeemable debt. So in practice, in real life, debt. Do you think that debt is irredeemable? In practice, debt is not irredeemable. that the company will be paying the interest forever. Like you would borrow, you not pay the principal. No. So in practice, debt is irredeemable, which means that the company will repay the borrowing at some specified date in the future, right? So the redeemable debt means the company will pay the the the, the lump sum or the principal at a specific period, right? At a specified date, at a, at, at a specified date, right? So that is with a redeemable debt, whereby the issuer pays the debt pays the debt at a specified what date, right? So yeah, the debt here means we want the principal, right? We'll be paying the principal, but we'll be paying the interest. We'll be paying the interest. Then at the fixed date, he will pay the principal, right? So that is the so it is redeemed. It is redeemed at a future date. At a future what date? To redeem at a future date. So what is the formula for that? What is the formula for a redeemable debt? Formula for the redeemable debt. The redeemable debt is the present value. Is the present value of coupons. Present value of coupons and the redemption value. If you look closely, you will see that it is redeemable is the price of the debt that we computed. You see, the general one, we said the price of the bond is what the present value of the cash flows, right? Of the cash flows or the coupons plus the present value of the what face value. So that is what you are seeing here for the redeemable debt. So for the redeemable debt, the price is the present value of the coupon and the redemption value. Redemption value is the future value over 1 plus R, right? Do you get a difference? Do you get a difference between the redeemable and the irredeemable?
Not really. Please explain again.
Yeah, so I said the redeemable. You see that the redeemable is the present value of the coupons plus the redemption value. So it's like the price of the bond that we looked at earlier. You see, we talked about the price of the bond. We said the price of the bond is the present value of the coupons plus the present value of the future values. It's not the same as the redeemable price of the redeemable debt as we are seeing here.
Yes.
Yeah, so it's the same. So now you know the difference between a redeemable and irredeemable. So we see the question that we saw was irredeemable debt. So that one you cannot, when you want to compute the price, you see you cannot come and use this one because it's an irredeemable debt. You get it? So that's where you use the formula that we used, that we had a unit and multiply it by this to get the 500,000. But this one is a redeemable, means the present value of the coupons in addition with the redemption value. I'm sure you are fine by now. Okay. So the redemption value. Redemption value can be at, it's the same thing that we discussed earlier, can be at what? At a premium. Either it is at a premium. Premium is whereby the the price is greater than the face value, right? The price is what greater than the face value. And I think the coupon rate is also greater than the yield to maturity, right? And the premium, the discount. So the redemption value can be at a premium, discount, or the par, discount or par, right? As it said earlier. Okay. So we can also see redemption value. Redemption value is higher of the par value. Is higher of the par value. Is higher of the par value and the convention value. All right, so let's look at a redemption example, and then we'll call it. Let's look at the redemption value example.
Mr. Fraser. Hello.
All right.
Hello. Hey.
Okay.
Please, I didn't get a last note.
The redemption value is higher of the par value, and then the convention value. Oh, okay. All right. So we read the example 3. Okay. So example 3 is a redeemable question. Read example 3.
Our PLC has in issue $400,000, 8% debentures redeemable in 5 years' time at a premium of 10%. Investors require a return of 12% per annum. Calculate the market value of the debt.
Okay. So we issue a debt 400,000, 8% debentures redeemable in 5 years' time, right? In 5 years' time to come. So that is basically future value. So you have to discount it into the present value. So what is the is action to calculate the market value of this debt? This is a redeemable debt. What is the formula for the redeemable debt? For the market value of a redeemable debt is the present value of the coupons plus the present value of the face value or the redemption value. Redemption value. Redemption value, right? So in 5 years' time, right, means annuity, right? Because it's issued 500,000, 8% debentures redeemable in 5 years' time at a premium of 10%. At a premium of what? 10%, right? Investors required rate of return is 12%. So here we can use the annuity. So let's use this table and see cash flow the discount factor, and then we get a present value. So here, year 1 to year 5, which is the annuity. Annuity is equal payment within equal intervals, right? So year 1 to year 5, how much is the cash flow? What is the cash flow? What is the cash flow of this bond? Issued 400,000, 8% bond. So he said that it was in a premium, right? It was bought at a premium, right? So premium, let's do some workings under. Right, at a premium of 10%. So how do we get a premium? Premium is usually higher than the what? Than the face value, right? If when we computed the price, we said the premium adds up to the face value. So it's usually greater than the face value, right? Did we say that?
Yes.
Yes. So the premium of we said it is the bond is denominated in 100 cities, right? 100. So okay, so the 10% times 100, that we get 10. That is giving us a premium of what? 10, right? And then how do we get the coupon? What is the coupon? The coupon is the interest. What is the interest on the bond? The interest on the bond is the coupon rate. What is the coupon rate? We said that PLC has issued 400,000, 8% debentures. So the coupon rate is what? 8% times the $100, right? In dollars, yes, in dollars. So what is the coupon interest? Coupon interest is 8, right? So they said that issued 400,000, 8% debentures, redeemable in 5 years' time. So you see the 8% debenture, which is the coupon, will be redeemable in 5 years' time. So that is annuity. So what is the cash flow for this coupon? Cash flow for this coupon is 8. The cash flow for the coupon is what? 8. And it will be discounted using the annuity factor. So how do we get annuity factor of 12%? So the annuity factor of 12% will be, how do you get an annuity factor? That will be C. So here we will not add a C because the C is already there. The C is already there. So using the annuity factor, it will just be the 1 minus 1 plus R exponent minus N all over R. So what do we have? We are getting, let me do it. So 1 minus 1 plus R. What is the R? R is what? 12%, right? So 0.12 exponent. What is the number of years? 5 years. Because it's 1 to 5, annuity. So exponent 5, negative 5. Okay. I'm forcing myself to write it here. Okay, so the factor, annuity factor. So that would be 1 into bracket 1 plus r exponent n all over r. So that is giving us 1 minus into bracket 1 plus 0.12. The rate is 12%. And the number of years is 5 years. All over the rate, which is 0.12. 0.12. So give me the annuity factor. What is the annuity factor?
3.60.
In 3 decimal, please.
3.604.
3.604.
605. 5, please. 5.
605. So that is the annuity. That is annuity. So 3.605. So we multiply this by this. So this is the C that is usually beside the formula. So the C is already here. So you multiply it. It is multiplying. So what will be the present value? Oh, multiply it by 3.05.
28.84.
28.84. Then at the end of the 5th year, what will happen? At the end of the 5th year, they are going to pay the face value, right? At the end of the 5th year, you are going to pay the face value. So you are paying interest for 5 years. You are paying the coupon for 5 years, and then when it's at the end of the 5th year, we pay the face value. But here the face value, they are saying that it is at a premium. So a premium of 10%. So 10% on the 100 is given as 10. So here we are going to pay 110 instead of the 100. You are going to pay the 110 instead of the 100. Because they said we are going to pay the face value at a premium. Payment is at the premium and not get the par value. So if they have said payment is at the par value, 5 years time at a par value, right? They would have maintained the 100 because par value is the same as the face value. If they have said at a discount, we'd have discounted the 100 and then less the amount from the 100. I don't know if you get it, but that is it. So this one is not annuity. This is a single year. So what do we do to it? We are going to say the future value over 1 plus r exponent n. So here it is how much? Okay, so give me the discount factor. Let's say 1 plus r. The discount factor is 1 over 1 plus r, which is 1 over 1 plus 0.12 exponent 5 years. Note that this is positive 5. The first one was negative, annuity, negative 5. That is if you are using the formula that I used. So give me the discount factor, 1 over 1 plus 0.12 exponent 5. What is the discount factor?
0.567. 567.
0.567. So multiply by this amount.
$62.37.
62.37. So you add all of them, and the answer you get becomes the market value. So what is that? Market value of this debt.
$91.21.
91.21. 91.21. You get it. So this is the market value of the debt. You can see that this one, the question is at a premium. So usually you pay the interest. The interest will be an annuity because it is within equal intervals, right? So that will be annuity. Use the annuity formula to get an annuity factor. The annuity factor, you multiply it by the cash flow, then get the present value. But at the end of the period, you pay the lump sum. You pay the principal, right? So if you pay the principal is either you pay the principal, which is 100, at the par value, or at a premium. So here it's saying that a premium means you add an additional 10% to it, but it said 10%, and the coupon to that's on the 100 cities, right? And that is giving us 8, which is the cash flow. So that is it. So that is it for the redeemable bonds. The redeemable bonds. So now you know what redeemable bond is and what the irredeemable bond is. Irredeemable bond is. Irredeemable bond is. So example 4 will be your assignment. Example 4 will be your assignment. Example 5 is a convertible bond. It's a convertible bond, which is what's the time 547 converted into 20. Okay, so please remind me that I will solve example 5 with you. It's a convertible bond, right? I'm converting it into shares, whereby we convert it into shares. So this is where we would end today's session. And another time, next time we meet, we will look at the valuation of securities, and also remind me that I should solve this question 5. But the question 4 is an assignment. The financial reporting assignment, I don't know if you still remember, but I've not received. I think I received from one person. Yeah. So on that note,